Welcome to Stress-Free Retirement, brought to you by the Oklahoma Financial Group. I'm Reed Mullins, and we're here with Michael White and Doug Rodwell, both from Oklahoma Financial Group. Good morning, gentlemen.
Morning, Reed.
Good to be back here with you. Michael, what are we talking about today?
You know, we're going to talk about the top 10 biggest misconceptions about annuities.
Annuities.
Yeah, which it seems that everybody's got an opinion on annuities, whether they really know much about them or not. We're going to shift gears a little bit from Medicare last week to some financial planning.
All right. An annuity, I know vaguely that I put money into it.
Yeah.
Take it from there, Michael.
Correct. Well, today we're really going to focus on fixed annuities. There are several different kinds. In fact, next week we're going to break it down and talk a little bit about the different types of annuities. That's one of the biggest misconceptions. So today we're going to focus on fixed. So safety is important. Safety is the name of the game.
And Michael,
today.
We're just going to hit the 5 of the 10 today.
Yeah, we're only going to do 5 out of the top 10. And so really, in the world of financial planning, we're going to be focusing on 3 phases of life. The accumulation phase, which is what we're building this wealth while we're working. And then there's a preservation period in there, near retirement, beginning of retirement, and then followed by distribution, where we have to start taking this money out of our retirement accounts. Mm-hmm. And so fixed annuities can be very appropriate for the preservation and distribution phases. Now, when it comes to safe money, there are 3 places we really can put our money, 3 acceptable places. You notice I didn't really say invest. I said put our money. It's savings. It's this money we've saved up all these years that we're going to keep it safe. And the safe alternative number 1 is government bonds that we hold until maturity. The second alternative is bank deposits, CDs backed by the FDIC. And then lastly, fixed annuities. And that's really what we're going to touch on a lot today. So fixed annuities differ from other investments, mainly because annuities are not transaction products. Unlike investments where there's buying and selling and moving of funds inside of the investment, annuities don't really work that way. Especially on the fixed annuities, they're designed to put your money in it and leave it alone. Leave it alone till you need it, usually measured in years, several years. So it's long-term retirement planning, and fixed annuities are designed for retirement or the retirement-minded person. We're not talking mutual funds. We're not talking about risk. We're talking about safety. Safety is important when we're talking about fixed annuities. Of course, Doug, tell us a little bit about other reasons why somebody might look into a fixed annuity.
Yeah, I might add a couple more things first, in that a person can use an annuity as an IRA. They can roll their 401k into an annuity as an IRA. So an annuity can accept both. That would be what the example that I just gave is called qualified money. It can accept qualified money, or it can accept non-qualified money, which is just writing a check out of your checking account. That's non-qualified money, and putting it into an annuity. A couple more reasons why people would buy an annuity is because the internal growth of an annuity grows tax-deferred. You're not going to receive a 1099 every year and pay taxes on the growth inside of the annuity. And the other is, in Oklahoma, the money inside of an annuity is completely protected from bankruptcy, from judgments, from court decisions, from liens, from garnishments, so that the money is ironclad. If you remember years ago, when O.J. Simpson just lost his $33 million civil lawsuit, he was still on TV playing golf.
Yeah.
His money is in an annuity.
Okay.
It could not be garnished by that lawsuit. Okay, and I'm going to just dive right into the first misconception, is that fixed annuities come with very high surrender penalties. I'm going to go back to the investments that annuities put the money in. The insurance company puts money typically in corporate bonds or government bonds. And so these are locked up by the insurance company for a period of time. And if the annuity holder surrenders their annuity prematurely, the insurance company then has to surrender their bonds prematurely to cover the money in that annuity.
Okay.
So there is a penalty for early surrender. But that all depends on the length of time your annuity is. It kind of acts like a CD. Similar, I'm just kind of using that as a comparison.
Right.
You have a 5-year annuity, a 7-year, a 10-year. So again, by putting the money in bonds, it allows the insurance company to diversify and not have all their eggs in one basket, and to be safe. Okay, we're not putting the money in the market at risk. Michael?
We talked a little bit about the surrender penalties, but the second biggest misconception is that all annuities charge high fees. So you talked about surrender fees, and that's to access all of your money all at once. You're going to pay some penalties on that because it's a long-term investment, right? Well, in terms of annuities charge high fees, we're talking in terms of annual fees that you're paying inside of the contract. And nothing could be further from the truth. There are some annuities that charge high fees, variable annuities, which is not what we're talking about today. But variable annuities sometimes come with very high fees. And the reason a variable annuity charges high fees is because there are multiple parties involved inside of a variable annuity. Usually the underlying assets are generally mutual funds, and mutual funds have managers that have to manage those funds.
Sure.
They're going to charge a fee. And then on top of that, the insurance company has got to do their administration. They may charge a fee. What it boils down to, there are several people with their hands all in the same pot, and they're going to charge a lot of fees for that. So the truth is, and the fact is, that the majority of fixed annuities charge no fees or very minimal fees. That's the end of the story. When it comes to retirement planning and you're using fixed annuities for your retirement vehicle, no fees to very little fees. Typically, the little fees is if you add on riders for things you want to purchase, because, again, annuity isn't a contract with an insurance company.
We have several options because some of that may be a better fit for some people than others. Absolutely. Is that kind of the way we're talking in general?
Annuities aren't a one-size-fits-all for people. It's they're appropriate for certain people, and they're not appropriate for others.
Are there some for maybe younger folks that are better than my age?
Typically we don't market these to younger people. These are for the retirement-minded person or the person in retirement. Remember, we're talking safe money.
Okay. Yeah, and what I would say, if I were to put an age to it, not limited to this, but I'd say age 50 up.
We have a lot more to cover and a lot more great information on the way with Stress-Free Retirement from the Oklahoma Financial Group on KZLS The Eagle. Welcome back to Stress-Free Retirement, brought to you by Oklahoma Financial Group here on KZLS. I'm Reed Mullins. We're with Michael White and Doug Rodwell. Michael, I had a quick question that was going through my mind in the first segment. When we're talking about annuities, can I buy those anywhere? Am I in the drive-thru at the bank and go, hey, I'd like an annuity? I probably can't do that. We've got certain people that can sell these, right?
There are a lot of different people that can sell annuities, but the truth is there's one quality that makes someone qualified to sell an annuity. So you can buy them from certified financial planners, registered investment advisors, registered representatives, even more. Typically, they call themselves an agent. The truth is, to buy a fixed annuity or an annuity in general, you have to hold a valid insurance license. You have to be licensed by the state of Oklahoma
to sell it.
To sell an annuity. So you buy them from an insurance agent.
And you guys?
Oh, absolutely.
Ready to go on that. You bet. Oklahoma Financial Group. By the way, it's okfingroup.com is the website for Oklahoma Financial Group. okfingroup.com. I want you to hit that while you're listening to the show today. And we're also going to give out the phone number so you can talk to us at the beginning of the week. Doug, we've got some more things to cover here on these.
We do. And the next item that I'm going to talk about is the misconception that annuities are so difficult to understand. They're just so complex. And to that, Reed, I'd say, amen, brother. Yes, they are.
Okay.
You tell me a contract that is not hard to understand.
Right.
Have you ever had a mortgage? I have.
Oh, yeah.
And it's about 30 pages thick, and you sign 15 times or 20 times, and no one ever reads through it. It's too complex. Well, in an annuity, the only reason an agent should be paid a commission is because they are educated enough to be able to explain to you how this thing works in simple language so that you understand it. So, don't be afraid to ask questions if someone approaches you about an annuity. And for goodness sake, if you don't understand what they're telling you, don't give them your money. That'd be my first piece of advice. On the complexity part, can you imagine a minister telling you not to read the Bible because it's too complex? Just stay away from that thing.
Okay.
No one's going to understand that. Or the complexity of how a TV works does not prevent me from watching my favorite shows. The moral to the story is just because something appears complex, it doesn't mean that it's not good for you.
Well, this is why we have guys like you. You are making this simple right now because even I'm following along.
Well, good.
Good.
I would say one thing, when you drill down to the basics, very basics about fixed annuities, they're really not that complicated. You give your money to an insurance company, and in return, they pay you interest via a contract, okay? And that's set out for a specific period of time. If you break that contract, they spell out exactly what they're willing to pay you. So it's that simple, and honestly, it doesn't sound that complex to me when you break it down like that.
Okay, yeah. What do you got for us, Michael?
Well, let's move on. Let's move on to misconception number 4. The money that I put in an annuity is all tied up. Again, with the proper kind of annuity, nothing could be further from the truth. The truth is, as long as you're using the money the way that you're supposed to be using it, there are ways to access it. So let's talk a little bit about that. First, let's say that unless you put your money under a mattress or possibly in a checking account at your bank, something like that, your money is going to be tied up. That's the truth. For safety, you're going to give up some liquidity.
Okay,
that's just how it is. And the truth is, with the stock market, someone might think that they have full liquidity of their stock market account. The truth is, they kind of do. But if you had your money in there and it dropped 30%, the odds are you're not going to liquidate it at 30% down, are you?
No.
Lose weight. So I would say that money's tied up.
Yeah.
I'd say that money's tied up. So just keep in mind, when it comes to safety, to get those guarantees, you're going to give up a little bit of liquidity. Now let's talk a couple of ways that you can access that money. Typically beginning at least with the annuities that I work with, I give you the following options. The first way is after the first month of the contract, you can request that the insurance company pays you the interest that goes into the account each month.
Okay.
So you can just draw the interest off starting after 1 month. The most common ways that people get money out of annuities as needed are each year you can access up to 10% free withdrawals. So you can take 10% of your account value out each year without any penalties or surrender fees.
Okay.
So you have a 10% liquidity. If someone were to put $100,000 in, you can access $10,000 a year without any penalties or fees. If you're diagnosed with a terminal illness or if you have to go to a nursing home, typically the insurance companies let you access all the money without any fees.
Wow, okay.
And then one of the biggest ones too, if you were to buy the annuity today and die a week from tomorrow, no fees. Upon death, all surrender fees are waived. Whoever you list as your beneficiary that's going to be entitled to that money is going to get that money without any fees. And now taxes may be a different story, but you can get it waived without any fees.
Okay.
After the surrender term is over, typically from 5 to 10 years is real common. There are some crazy annuities out there that go out to 16 years, things like that. But 5 to 10 years is real common. At the end of that 5 to 10 years, you can walk away, take your lump sum of money, and do whatever you'd like with it. So once the surrender period's over, you can walk away.
And I'd like to point out that is, in fact, what most people do. We hear about annuitization and that type of thing, but most people either walk away with the money and do something else with it, or they create an income stream for retirement.
Which Doug actually just touched on the next two that I was going to talk about, that you can annuitize and take a monthly income for the rest of your life or a specific number of years. It's probably one of the least common ways that people get money out of their annuities now. It's not the way it used to be, but that's how it is now. Typically, people get their income, guaranteed income for life, out of their annuities through the use of income riders, which you can start income, stop income, take lump sums, a lot of flexibility there. And finally, you can cash out your annuity at any time, but remember, if it's within the surrender period, you're going to pay some penalties on that. So when it all boils down, the right type of annuity is very, very flexible and accessible at any time as long as you use it appropriately. And this isn't a guessing game. When you buy these annuities, there are contracts and everything is spelled out exactly how you can do it. We've only got one more misconception we're going to talk about. Nothing is left for my family when I die.
Yeah, that's because that weighs on everybody's mind.
You know, a lot of people are worried about that. But you see it a lot in pensions. People retire and get a pension. They'll select the wrong type of, a lot of pensions are annuities. And people select the wrong payment option and they pass away and nobody gets any of the money. So we'll talk a little bit about that when we get back. Why don't we hand out our contact information one more time? You bet.
And if you want to reach Oklahoma Financial Group, I'm telling you right now, the answering machine is on. We want to talk to you. So leave your name and your number, and we'll contact you first thing Monday, 405-310-0098. 405-310-0098. Online for Oklahoma Financial Group, it's okfingroup.com. okfingroup.com. Back with more on annuities with stress-free retirement on the Eagle. Welcome back to Stress-Free Retirement, brought to you by the Oklahoma Financial Group. We're here with experts Michael White and Doug Rodwell with great information on annuities, and we've got some myths and misconceptions about annuities. You got one more big one for us, Doug, that I think weighs on people's minds a lot. What is that?
Well, I'm going to talk about the misconception that nothing is left for my family when I die. If I could, though, before I do that, I want to plug a great book I think the listeners would like to get and read through. It's written in just common sense English by Tony Walker. It's called The 10 Biggest Misconceptions About Annuities. And we get a lot of our information from that, even though we're in the business. He just writes a good book. You can find that. And by the way, we don't get any compensation for doing this.
Sure.
We just want to let people know about it. You can find that book on Amazon, or you can go to TonyWalkerFinancial.com. It's just a little paperback, about 25 pages long.
And we'll probably have that link up on the Financial Group website, too?
Yeah, we'll probably put that link up there.
okfingroup.com.
Right. So the misconception that nothing is left for my family when I die, again, with most annuities, this simply is not the case, unless a couple things occur. But typically, with an annuity, you name a beneficiary. If I buy an annuity today and die next week, my beneficiary is going to receive the full amount.
Okay.
No surrender charges, nothing. Now, there are some annuitization options that could limit a beneficiary on what they receive. Those are very rarely taken and very rarely advised to be taken. So just make sure that the agent knows what he's talking about. Ask a lot of questions, and let that be one of the questions. What is my family going to get if and when I die? Okay, so if you convert it into lifetime income, you may have a problem without specifying a number of years to get the income. Mm-hmm. But typically speaking, you can name a beneficiary, and when you die, boom, they get a check.
Okay, that's comforting to know.
Yeah, you typically see that first scenario where someone selects a lifetime income and then passes away and nobody gets the money when you're talking about pension plans through retirement plans with your employer.
Okay.
So before you take a pension payout from your employer, come talk to a financial advisor. Get some advice on what selection you ought to take, because usually you've got several different options you can pick from.
Now, we're only halfway through the myths and misconceptions, so what are we going to do next week, Michael?
Next week, we're going to come back and talk about the second half. We got 5 more that we're going to run through. I don't think I've got time to tell you about all of them today, but we're going to talk about the different types of annuities and how confusing they can be. As well as annuities aren't good for older folks. That's a total misconception. That's typically who they're ideal for. Again, I just want to clarify, when it comes to all of our assets, we've got at-risk money, we've got safe money. Fixed annuities are great investments for the fixed money bucket.
Okay.
Money that you want guarantees, money you can't outlive. Things like that. There's a lot of guarantees you can get from these fixed annuities, and don't run from them just because your neighbor told them they had a bad experience from them.
Okay, very good. So we hope to see you right here, 7 o'clock Saturday morning next week for more stress-free retirement. In the meantime, call 405-310-0098, online, okfingroup.com. Stress-free retirement on KZLS The Eagle.
The opinions voiced in this program are for general information only and are not intended to provide specific advice or recommendations for any individual. To determine which investments may be appropriate for you, consult with your attorney, accountant, and financial advisor or tax advisor prior to investing. On behalf of Doug Rodwell, advisory services are offered through Investment Advisors, a division of Pro Equities, Inc., a registered investment advisor. Securities offered through Pro Equities, Inc., a registered broker-dealer and member FINRA and SIPC. On behalf of Michael White, investment advisory services are offered through Red Hawk Wealth Advisors, Inc., an SEC-registered investment advisor. Both are Futurities First Insurance Group agents. Futurity First is independent of Pro Equities, Inc. and or Red Hawk Wealth Advisors.